Good afternoon, everybody. It's Mark Mandelbaum. I'm chairman of Lanterra Developments, and I'm welcoming you, all my guests, to another of our Lanterra webinar series. We're honored to have special guests today with us, a very good friend, Benjamin Tal, who is the Deputy Chief Economist, CIBC World Markets. Now, Benjamin does not need an introduction to our audience today. In fact, if I remember correctly, at the very beginning of COVID, Benjamin, probably one of your first COVID speeches was for a Lanterra webinar. And back then, the conversation was, how long was it going to last? Third quarter, U-shape, V-shape. We're 9 months into it, 10 months into it, into a second wave, post-election. I don't think I've ever experienced so many things happening that have such a direct impact on everything that we do. So it's a big honor for me to be able to introduce you today and welcome all of our guests. Now, we have always invited to our webinars our real estate agents who we are so close to, our VIP Platinum agents, many of the real estate agents who deal with us, our clients, our business associates. A special welcome to many other groups of associates that we deal with, particularly the Terra Firma Investor Group, and all of our other partners and business associates and banks. Benjamin, I could tell you everybody is very, very eager to hear what you have to say and share with us your thoughts. Now, I will disappear from the screen while Benjamin makes his presentation. There is a Q&A, a button on the bottom of your screens, and I would invite our audience to type in your questions. At the end of Benjamin's talk, we will be fielding certain questions. And with that, I turn it over to you, Benjamin. Thank you very much for joining us today.
Thank you very much, Mark. A pleasure to be here. Of course, so much to talk about and really not enough time as usual. There's so much to talk about, and I will try to be relatively brief. I will start with what's happening in the US, of course, what it means as far as Canada is concerned. We'll talk about the trajectory of the virus, what we know, what we don't know, the vaccine. We'll talk a little bit about the nature of this recession. Why is it so different? Government policies, how effective they are, if they are. And of course, what it means for housing, interest rates, the Fed, the Bank of Canada. And if we have time, maybe a little bit on the long-term implications of this crisis, and maybe we are exaggerating the impact of the crisis on the long-term trajectory of the housing market. So let me start and see what makes sense and what doesn't. And let's go to the first slide, which is dealing with Biden. I will make a wild assumption here that Biden will end up being the president, despite the fact that Trump is not agreeing with that. And I will also suggest that Georgia, the election there, you will see a situation in which the Republicans will take the Senate there. Therefore, you will have a divided government. This is a reasonable assumption at this point. Usually markets outperform, historically speaking, in a divided government situation because they basically say politicians get out of the way, and the Fed was lifting the market, compensating for the lack of political action. This time around, I think that will not be the case because the Fed is exhausted. The ability of the Fed to lift the economy is very, very limited. But I believe that Biden will surprise by how much he will be able to achieve in a divided government. So let's go very quickly over a few things that might impact Canada. A COVID-19 plan, clearly there will be a plan under Biden, and there will be more restrictions, which means that the economy will be more closed relative to Trump. Tax plan, he wanted to introduce a $3.1 trillion increase in taxation. That's not going to happen. However, there will be some compromise. He might be able to pass credit for the green economy while exchanging all kinds of other things giving to the Republicans. So he might be able to do something there, not even close to what he was planning. He also wanted to focus on the stimulus bill of about $2.5 to $3 trillion. If he's lucky, he's going to get one and a half. trillion dollars. This is not even close to what he wanted. He wanted $2.5 trillion on infrastructure. He will get maybe a fraction of it, but there will be some infrastructure money. Trade policy is where you have a lot of room as a president, and we are going to see the continuation of Trump's policy of deglobalization. The fact that Trump is Trump does not mean that he is wrong on everything. He's not wrong on China, and Biden knows that. So you will see really a separation of the two trading blocs, the US and its friends, and China and its friends. And this is a semi-Cold War, especially when it comes to technology, something that will impact us. And I think that our reliance on the US will rise over the next 4 years, given the deglobalization and the trade war that we are seeing between the US and China. That will continue. Immigration will be a negative for us. Why? Because under Trump, there wasn't much competition regarding immigration because he was closing the doors, as you know. Biden will open the door, will increase the quota, which means that Canada will have to compete with the US to attract high quality immigrants. And we are raising our quota to 405,000 a year. So it will be a bit of a challenge to think about. Energy, Keystone is clearly a negative for Alberta because Biden is going to cancel it. But at the same time, Biden is going to introduce a lot of regulations on US energy, which ironically can benefit Alberta. So it's really depends how you look at the situation. It's not just negative as far as Canada is concerned. You look at the healthcare, it will continue to reduce drug costs the way Trump did, but he will not be able to go with the public option, public insurance option. So that's something that, again, you want to do something, you will not be able to. So overall, we are going to get a muted Biden, if you wish, or Biden light. He will be able to do a few things, but at the same time, given the fact that it will be a divided Congress, he will not be able to go with the agenda of a blue wave. And that's something that will limit the ability of politicians to move the economy, but at the same time, the Fed will not be able to save the day because the Fed is exhausted. That's the way I read the political situation in the US in terms of policy. Of course, we are starting to see that the excitement about the elections is almost over, and the market is starting to focus more and more on the vaccine, on the virus, and the trajectory of the virus, and that will impact the mood over the next few months. So let's discuss it, and let's go to the next chart very quickly. And the next chart is telling you that the US is very, very different. The US is very different. This chart is telling you that at a given level of infection, the US economy under Trump is much more open than any other economy, Canada and Europe. So the positive spin on that is that economically speaking, the US is outperforming. The negative, of course, is that the infection rate is much higher. And what Biden will try to do is to get the US back to where Canada and Europe is in terms of the ability of the economy to open. And if you wish, the conflict that is defining this crisis, the conflict between lives and livelihood, is in full display here in the case of the US. And why is it important? You go to the next chart and you can see that this is not over by any stretch of the imagination. If you go to the next chart, you can see that. You can see that we are basically in a deja vu situation. And I think that you're missing one chart here, but we are very close. It's okay, stay there. We are basically very close to the 1918 situation where there are 3 waves there, and we are basically seeing the same thing now. I don't think that the second wave will be the last wave. There will be maybe a third one in the US. So history is repeating itself. And if you go to the next chart, you can see why it is so important. Because we already have some countries like Japan, South Korea, Australia, that are at the end of the second wave. So we can learn from their experience. And what we know, that's extremely important from your perspective, is that you can bring the virus down, like in Australia, like in Japan, without shutting down the economy completely. From the chart to the right, you can see that, yes, they are able to bring the virus down, but the mobility index is down much less than in March or April, if you do it right. And that's extremely important. And that's why we have to talk about the fear factor versus the availability factor. That will dominate the agenda over the next few months. What I mean by that is that at a given point in time, you have a conflict between fear and availability. A restaurant is open, it's available. Are you going there or not? Now, we know that early in the crisis, the fear factor was dominating. How do we know that? You look at two states, just as an example. In early March, Wisconsin and Minnesota, both of them shut down the same day, basically. Then a few weeks after, in May, early May, Minnesota opened up, Wisconsin didn't. So you had a full month in which one state was open, the other was closed. You follow consumer spending during this period, it was basically identical, which means that the fear factor was dominating the availability factor. And that's something that we have to take into account. That's something that we have to take into account when we look at the next few months. That was early in the spring. During the summer, clearly, the fear factor was disappearing. People were more open, the happy days of the summer. And I fear that the fear factor will start dominating in the winter. We all know that. And that's why if you look and take all this information and translate into economic numbers, that will be in the next chart. You can see that in the second quarter of the year, economic activity was down by 40%. That's when we had our first conversation. We were in the process of seeing the economy going down by 40%. We have never seen anything like that. In the third quarter, during the summer, it was up by 40%. And now we are entering the colder days of winter. And even the Bank of Canada is telling you, we are expecting to see basically no growth or very little growth over the next 4 or 5 months. The second wave, the overlapping with the flu season will confuse everybody. We all know that. However, we are getting very good news from the vaccine front. You're all aware of that. I'm not going to get into it. We have 2 vaccines already, over 90% effectiveness. We have 7 more vaccines coming in a very advanced stage. So the issue will not be if we have a vaccine. We are going to have a vaccine. The issue will be logistics. How quickly you can, make sure that everybody gets it very quickly. And I think that the more I talk to people, the more optimistic I am about 3 things. In January, we're going to get rapid testing. That will be a very important factor. We're already seeing better antiviral medications. And by the second half of the year, we are going to have a vaccine, a workable vaccine. This means that the second half of 2021 is going to be a very, very strong economic period when it comes to activity. I'm talking about 5-6% GDP growth in the second half of 2021. Between now and then, we have to go through the winter. And that's why government policy is very important. So we have to understand the nature of this crisis. So let's start and let's look at the next chart. And the next chart is telling you where we are now. Look at the chart to the right. We were down by 30% or almost 40% in the second quarter. We were up by almost 40% in the third quarter. But of course, the up 40% started from a low base. So we are still 4.7% below the level we have seen before the crisis. 4.7%. Now look at the chart to the left. This is the financial crisis of 2008. From peak to bottom, we were down by 4.5%. Now we are down by 4.7% after recovering. So we are recovering into the darkest day of the mother of all recessions. That's the nature of this crisis. It's significant, and that's why government policy is so important here. Let's go to the next chart and go deeper into it. And you can see that this is a very asymmetrical crisis. 2/3 of the economy are now experiencing basically a V-shaped recovery. 2/3 of the economy in a V-shaped recovery, full swing. 1/3 of the economy is still stuck in this L-shaped recovery. And I suggest that if those industries were unable to recover during the happy days of summer, surely they will not be able to recover during the darker days of winter. Government policy here is so important, but 2/3 of the economy experiencing a V-shaped recovery. Very important, the most asymmetrical recession ever. You go to the next chart and you can see what it means. It means that this crisis is very, very deep, but narrow. The number of industries that are heavily impacted is much lower than what we have seen in any other recessions. And if you look at industries like the real estate industry, facing the mother of all V-shaped recoveries. So what it means that when we get to the other side of this crisis, let's say the second half of 2021, the ability of the economy to recover will be actually more promising than any other recession because the focus is relatively narrow base. And you don't need too many industries to recover to see a full recovery. And that's basically where we are. Another aspect of the abnormality of this crisis is in the labor market. You go to the labor market, that's the next chart, and you can see that the vast majority of jobs lost during this crisis were low-paying industries. Today, it's about 90%. 90% of all jobs lost during the crisis were in low-wage industries. Usually, it's 50-50. This has major implications. Remember the statistics when we discuss the housing market, because this is one of the reasons why the housing market is doing so well. Remember these statistics, the abnormality, the asymmetrical damage in the labor market. Let's go to the next chart and go even deeper into why this recession is so different. This is a service-oriented recession. We have seen a situation in which every other recession in history was led by the goods segment of the market. This one, because of the nature of the crisis, is led by the service sector. In fact, goods are up. Now, what's happening is that we look at government money when it is being deposited into accounts, and we see where the money is going, where people spend this money. And about 70 to 80% of this money is being spent on goods as opposed to services. Remember, goods did not go down. Services did. So in this way, what we are seeing is that government money is supporting not struggling small businesses in the service sector, but rather the Amazons of the world. This is not a criticism, but this is the way it is given the very specific nature of this crisis. Very, very quickly, you go to the next chart and you can see something even more interesting. Most of the decline in spending is actually happening among high-income individuals. Low-income individuals did not see their spending going down as much, And it makes sense if you think about it for a second, because low-income households spend most of their income, government money or their money, on necessities. So they don't reduce their spending much. High-income individuals reduce their spending dramatically. This has major implications. For example, if you are a small business that is tailoring to high-income neighborhoods, your business is going down faster than a small business tailoring to low-income neighborhoods. And that's exactly what we are seeing in high-frequency data coming from the US and Canada. So this means that the nature of this crisis is so different, it's abnormal, it's asymmetrical. And therefore, government policy must be consistent with this trajectory of the crisis. So let's see what governments are doing and what it means as far as interest rates, exchange rates, and your business is concerned. Let's go to the next chart. And you can see that Canada is second to only Japan in terms of spending relative to the share of the size of the economy or per capita. Our damage was more or less consistent with other countries, but our spending is second only to Japan. And the question is, are we spending too much? Can we afford it? The debt to GDP ratio in Canada was 30% before the crisis. It is now 50%. And as you can see from the next chart, a lot of this money is going to households that maybe don't need it. Listen to this, this is amazing. This is the first recession ever that income is actually rising. Not only is it rising at the fastest rate ever. Today, listen to this. Today, Canadian households are sitting on no less than $90 billion of extra cash in their deposits and savings accounts. $90 billion of excess cash. We have never seen anything like that. This cash will be redeployed into the economy the minute we see the light. Some of it will go to real estate. This liquidity bubble is going to be utilized in a very aggressive way. That's one of the reasons why I believe that the economy will rebound quickly in the second half of 2021, because there will be enough ammunition to generate this kind of activity. And most of this extra money is sitting in checkings account of very wealthy Canadians, which means that the savings rate that is now rising will go down and will be injected into the economy. And again, part of it will go into real estate. $90 billion. Corporations, by the way, are sitting on an extra $80 billion. So there is a lot of money in the economy, all in cash, waiting to be redeployed. Very, very interesting, something that we have never seen. In this environment, who is going to pay for the debt? And the point that I'm making is that we have to be careful. Before we start taxing people, we have to make sure that this money is being spent wisely. And again, I'm not in the business of criticizing the government, because that's not very productive. They are trying to do what needs to be done, but they are doing it very quickly. We put together policies and programs that's supposed to take 5 years to put together in 5 minutes. So of course they are full of holes. I'll give you an example just to give you a sense of what's happening. Every month when we get the number of unemployed, we ask people, Stats Canada, ask people, what did you do the month before you were unemployed? So either you were in a different job and you lost your job, or you were, let's say, a student. You were not in the labor market, you were not even looking for a job. And over the past 6 months, we have seen a huge increase. In fact, 50% of the increase in the number of unemployed were students that just a month before were not in the labor force at all. They were not even looking for a job, they were not unemployed. All of a sudden, all of them are becoming unemployed. They are registering as unemployed. Why? What is the reason for this sudden interest in becoming part of the labor market? And the answer is maybe the availability of CERB money, the $2,000 per month, had to do something with that. Maybe. The point that I'm making is that the new wave of government assistance must distinguish between a 17-year-old student that is not happy with his or her allowances and a 45-year-old parent of two that is unemployed. We must distinguish between the two. There is no unlimited amount of money that we can spend. Who is going to pay for this debt? Nobody. At least not in the near term. We are going to see a situation in which governments will refinance their debt at lower rates, and the debt level is rising from 30% of GDP to 50%, more than $1 trillion, but the interest payments on that debt are actually falling by $4 billion, reflecting low interest rates. That's very important. Beyond that, I believe that you will see a situation in which 2 or 3 years from now, governments will be very tempted to start raising taxation because the level of spending will rise on a permanent basis. Before the crisis, government spending was 15%, 1/5 of GDP. Now it's 30. It will go down, but it will go down to, let's say, 17, 18. The difference between 15, 17, 18 will be the fact that without even knowing, we are putting together the plumbing for tomorrow's social assistance program in Canada. That will be costly, that will have a permanent impact on spending, and that's why there will be some temptations to raise taxation, maybe a higher inclusion rate on capital gain, financials, not real estate, maybe taxes on dividends, maybe take a carbon tax, get them back to general purposes, maybe tax on big tech, and maybe if they are totally desperate, a 1% increase in GST that will give them like that $7 billion. I doubt they will do that because it will be a political suicide, but that's the direction we are going. Not now, not a year from now, but when we are on the other side completely of this crisis. Now, this is fiscal policy. Monetary policy was very effective in its way to make sure that the system is functioning. Early in the crisis, the fear was that the system will not be able to function. And the Bank of Canada and the Fed injected liquidity to the system in the BA market, in the repo market, everywhere. Now the market is functioning and the Bank of Canada is moving from injecting liquidity and making sure that the system is working into maintaining economic stability and a normal recovery. That's basically what they're trying to do now. I will not get too much into it. If you go to the next chart, what it means that the Bank of Canada and the Fed, and you're missing one chart here, but it's fine, means that you have a situation in which the Bank of Canada and the Fed will not touch interest rates until 2023. And what we are going to see soon is a widening in the yield spread or steepening of the yield curve. Basically, the 5-year rate, the 10-year rate will start rising slowly. We have seen it already when the announcement on the vaccine was there. We have seen some upward pressure on long-term interest rates. That's what we will be getting, I say, from basically spring of 2021, when the market sees the light, and you will see a widening in spreads, a steepening in the yield curve. Short-term interest rates will remain low. Long-term interest rates will start rising very, very slowly. But as you can see from the next chart, even when interest rates go up, they will go up so slowly, and the new peak will be much lower than the previous peak. So interest rates will remain low, although I suspect that long-term interest rates will be rising faster than short-term interest rates. Given this environment, let's discuss for a few minutes the housing market. Next chart is telling you that the housing market is experiencing a full swing V-shaped recovery. You know the story. I don't have to tell you. It was a very strong summer and fall in terms of sales prices. Now, if you go to the next chart, you can see that we are strong, but it's not strong relative to, in terms of sales, relative to the long-term average and the demographic requirements of the country. And at the same time, however, I think that you cannot really compare the current situation to normal times. You have to compare the current situation to another recession. And if you go to the next chart, that's exactly what we do. And you can see that this is by far the most housing market friendly recession ever. In the other recessions, we have seen a significant decline in sales. And this is the amount of the decline in sales that you can see in other recessions. Today, nothing, which means that this has been a very housing market friendly recession. The question is why? You go to the next chart very, very quickly, and you try to figure out to what extent prices are rising because there is more activity in Vancouver or in Toronto in the expensive centers. Those two lines, usually when there is more activity in Toronto and Vancouver, they're separated, which means that the regional factor is not playing here because it's happening everywhere. The gap between those two weighted and unweighted is zero, which means that it's not really a Toronto, Vancouver story, it's more general. So let's go deeper and go to the next chart. And the next chart is basically, from your perspective, the average versus the benchmark. The average is just comparing everything, without really taking into account what you're comparing. The benchmark is comparing condos to condos, low-rise to low-rise. And you can see that the average is much higher than the benchmark, which means that about 50 to 60% of home price inflation is due to the composition factor. The composition factor means that people are buying bigger units. Bigger means expensive, so you have more activity in the more expensive segment of the market, and that's why prices are rising. About 50 to 60% is not just an increase in price per unit, but the composition factor, more activity in the more expensive segment of the market. Let's go deeper and say, okay, why? How can people afford it? And the answer, of course, yes, interest rates are very, very low, which is true. However, back then in 2008, when prices were going down and activity went down, they did not have stress tests. There was no B20. Today, as you all know, you have to qualify fixed and variable at, I think, 479. So if you look at qualification rates today compared to 2008, today's interest rates in terms of qualification are actually higher than they were in 2008. But despite that, activity today is much faster, much stronger than in 2008. So it's not just about interest rates. It's much more than that. So let's go to the next chart. And remember the story about the labor market? Remember the abnormality of the damage that we have seen? This is what we are seeing now. The fact that the vast majority of jobs that were lost during this recession were in low-paying occupations means that you have a larger segment of the population that did not feel the damage financially. They were untouched by the crisis financially. So they were in a position to qualify and take advantage of low, extremely low interest rates. That's the opportunity that they were waiting for. This is very different than any other recession, that about 45, 50% of jobs lost were in high quality jobs. So you didn't see that. Today, most of the people that lost their jobs were renters, which means that you have a higher segment of households that is able and willing to take advantage of low interest rates. That's the story. That's the real story behind the success of the housing market. And if you go to the next chart, you can see that clearly we're starting to see a situation in which the detached segment of the market is starting to outperform the condo space. Two reasons. Remember, the single family detached segment of the market went through a correction when B20 was introduced. Remember that, it was basically dead. The condo space didn't. So that's one thing. So the starting point is different. Second, there is an element of inventories. There is no supply of detached. We are seeing some increase in supply in condos, and you can see it in the price trajectory. You go to the next chart, and you can see that this probably will continue over the next 6 months or so, in which there is simply no supply of single detached, and that's where the demand is. But let's go deeper and look at the trajectory of prices by price level. I think you will find it very interesting. If you go to the next chart and focus on the left, that's the red, that will be Toronto, the right is Vancouver. What I was interested to know is to what extent prices are rising faster at the higher or the lower level of the condo space and the detached segment of the market. So focus on the right, on the left side, the red, the left is condo, GTA. And you can see that the distribution is relatively, uniform, with the exception of maybe in the middle, you see higher inflation. So just to make sure that you understand the chart, if you go to the left, it means cheaper units. 5 is the middle, and 10 is the most expensive. So, and then you see to what extent inflation is rising, or home price inflation is rising faster or lower at the cheaper or more expensive segment of the market. You look at the detached segment of the market, the right red, and you can see positive correlation. The more expensive the unit is, the faster its price rising. In Toronto, which is obviously not a positive for mover-uppers, because the target, its inflation is rising faster than their unit that they're selling. You go to Vancouver, just to illustrate the chart to the right, and you can see that there is a negative correlation between price and the price level. Namely, the more expensive the unit is, the lower the inflation is. In condos and in low-rise, to me, that's a reflection of the reduced amount of money coming from foreign investments on Kong, China. We know the story. So overall, I suggest that this is a reflection of a market that is now stabilizing. To me, if you look at the housing market in general over the next 6 months, I think the housing market will weaken. I think that you will see low-rise stabilizing, and we are starting to reach a resistance price in low-rise in which people will say, I'm not paying more than that. The condo space is seeing a significant number of completions in 2020, as we all know, close to a record high. That will have an impact on inventories in the coming 6 months or so. I suggest that what we are getting, the signal that we are getting from the resale market, probably will impact the new construction market, and it will start stabilizing and soften a little bit. However, I really suggest that we are already seeing the end of the correction trajectory. We are already starting to see people realizing that rent downtown Toronto is becoming more or less the same as rent in the 905. And at one point, they will say, you know what, I'm taking advantage of it. And therefore, although I expect the housing market in general and the condo space to soften over the next 4-5 months as the economy as a whole slowing down, and we are dealing with the supply that basically happening because we were accelerating activity and front loading in terms of launching, as we all know, this will be a short-term period. And as we reach spring, which I believe would be a very strong spring from a housing market perspective, I think there is a reason to believe that this correction will be behind us. And that's really important because we have to look at the long-term implications of this crisis. And I think that people exaggerate the impact of the crisis. Let's go to the last chart and discuss some of those. You know, when you are in a situation, you tend to exaggerate the long-term impact of this situation, and we are in a situation. So people talking about not going back to the offices, e-commerce, you know what, we will go back to the office. It will be maybe in terms of demand for office space, it will go down by maybe 10, 15%, but it's not really a game changer that will change the story dramatically. People will go back to the office. E-commerce, yes, it's gaining market share like there's no tomorrow. We gained 10 years in terms of market share relative to retail in 6 months. But over the last 2 months, we lost 5 years in basically 5 minutes. So we exaggerate the story. Clearly, e-commerce will be there like many other trends. Every crisis is a trend accelerator. This crisis is not different. All those trends that we are seeing were there before. They were simply accelerated. The move from downtown to the suburbs happened before, simply accelerated during this period. Retail. I suggest that pent-up demand will be there. Offline shopping will be exotic, and the dividing line will be quality. I believe that shopping malls that are high quality / expensive will do extremely well the minute we reach the second half of 2021. Online services, some more permanent changes in banking, doctors, clearly education will change dramatically, I believe, in terms of online. Leisure, travel, by 2023, it will be very, very busy. Restaurants, people will be lining up the minute we have the green light. There is so much pent-up demand. Even business travel will go back, but it will be an incomplete recovery, usually negative for downtowns, especially hotels. And deglobalization started with Trump and will continue with Biden, no news here. So I suggest, to sum up, we have to go through the next few months. The next few months will be difficult. The number of infections will rise, the economy will slow down, the flu season will overlap with the second wave, maybe a third wave, and that will have a significant impact on overall activity. The housing market that has seen a huge V-shaped recovery will feel the weakness, and the high-rise segment will feel it more than the low-rise. However, we are already at the 7th or 8th inning of the slowing down, as we are seeing already in the resale market. And the rental market is starting to stabilize when people realize that they're sitting on a bargain. This is consistent with the assumption and the assessment that as we get into the other side of this crisis, those long-term trends will not continue forever, and we are exaggerating their impact. In between, we are buying time. And by doing so, we need government policies, and you will see governments and central banks continuing to support the economy in terms of injection of liquidity and money transferred directly into the pockets of Canadians. Overall, I think that interest rates will remain very low, another factor that will help the trajectory of real estate. And we are sitting on a mountain of cash, $170 billion of extra cash that will be utilized when we see the light, and real estate will benefit from that. I will stop here and let's see if we have time for Q&A.
Hi, Benjamin, that was great again. Thank you very much. I do make note that we have about 200 participants, and our participants, I think you are pretty much aware, are very sophisticated in the market. Almost all of them are focused on real estate, but they are very, very sophisticated, and obviously they have questions. I could maybe just a few thoughts that I would have. I could tell everybody before we went live, I was schmoozing with Benjamin, and he said that in the last few days you were in Mexico, China, I forget the names of all, Tokyo, where all the places you were at?
Yeah, Hong Kong, I was everywhere. Yeah.
All virtually, right? So a year ago today, if you would have had the same conversation, you would have actually been there physically, right?
Exactly.
And things worked for you?
I'm enjoying it, quite frankly. I'm not missing the airport, that's for sure.
So in 2021, what do you think is going to happen with your own personal schedule?
You see, I think that when we have big conferences, like more than, let's say, 50 people, I will be there physically. But if I have to go on one-on-one trip to New York, I will do it vis-a-vis Zoom. And I think that's what will happen. I think that the business meetings will happen like that. But bigger conferences will happen in person because that's the experience. So I think we have to distinguish between the two. And that's why part of my points regarding the long term, that business travel will not have a full recovery because people will realize that there's no need to spend money and time if you can do that.
All right, we have a few questions and answers, but they all, I could tell you quite interestingly, are twigging on the things that I personally were twigged on. One is the amount of liquidity that you're referring to and how that's going to be deployed. There's a lot of interest among the questions. It's surprising to me. I would not have guessed that.
Yes, because it's a big number. It's something that we have never seen before. The abnormality of this market means that the savings rate went up dramatically. Usually that's not the case because income did not go down. In fact, it went up. Spending went down dramatically, especially among high income individuals, which means that they really have a lot of cash that cannot be utilized at this point. So as I suggested, $90 billion, I estimate, extra cash. This money will be utilized one way or another. And now we are speculating how. Interest rates will remain.
Just 1 second before you go further.
Yeah.
Part of that question was all that money because of higher incomes, or how much of that actually started in the government's pocket and ended up in people's pockets?
I think a lot of it is to do with reduced spending and high income. I suspect that many people who get government money are not saving this money, they're using this money. But high income Canadians, mid-income Canadians that saw their income untouched, but their spending went down dramatically, that's where the savings coming from. And these savings eventually will be utilized one way or another. And part of it, I believe, will find its way into the real estate market directly or indirectly. And I will not be surprised if you see even an increase in the gifting as a down payment for younger generation.
Okay, I'm actually following the questions and I'm trying to consolidate and paraphrase some of the questions. A bit of concern about whether all the spending from the government is going to end up wreaking havoc with inflation somewhere along the line.
Yeah, that's a good question. There are two things that we have to think about when it comes to the central bank. One is credibility of the central bank, which is important, and the other is inflation. Credibility, I mean that in Economics 101, they tell you that the independence of the central bank is key. And let's face it, the Fed, the Bank of Canada, they are not central banks. They are crown corporations. They are government agencies. They are printing money for the government. They will have to labor very, very hard to regain that credibility. That's number one, but they will do it. Number two is inflation. Again, Economics 101 will tell you, you print money like there is no tomorrow. That's not only inflationary, that's hyperinflationary. However, that's very important. In order to see inflation, you need to see not only money supply rising, and it is rising, you need to see the velocity of money rising. You need to see this money exchanging hands. And that's not happening now. And as we know from the experience of Japan, the Eurozone, and even the US after the crisis of 2008, without the velocity, you don't have inflation. So I'm not losing sleep over inflation anytime soon. And I think that only if the government or the Bank of Canada or the Fed make a mistake and continue to print money when the economy is already in a full swing recovery, then we will see inflation. There is no reason to predict that they will make that mistake.
All right, let me put together a few things that you said and put together a few of the questions. You made the observation that Canada allowed 405,000 immigrants. Very few of them came in the last several months, right? None of them actually, right? So anecdotally, I hear from a lot of people in the industry that there's an expectation that there's going to be a lot of immigrants. You may have to compete a bit with the United States if Biden gets in and allows more immigration. Just as my own observation is, I think internationally, if somebody had a choice going forward, whether to immigrate to the United States or Canada, given how, you know, our political and health system and just how we behave, like my guess is a lot of people, despite the weather, would probably choose to come to Canada. So how would that, if it does materialize, and we expect it to materialize, how does that impact on your housing supply, absorption, your prices, and that divide between housing and condominiums?
Yes, I think that it's very important to understand that this decline in the number of new immigrants was temporary, and we're going to compensate for that over 3 years. Uh, Beyond that, I think that ironically, this crisis is positively demographically speaking, is positive demographically speaking relative to when it comes to Canada. Why? Every year, there are 100,000 Canadians moving to the US. Those are the brain drainers. That's not going to happen. It's not happening this year, and probably will happen less next year and the year after, especially if you can work for a New York company from your basement in Etobicoke. So that will reduce the number of people moving out of Canada, and therefore will increase demand for real estate. That's 100,000 people staying with the real estate. That's very important. Another factor that people are not talking about, I estimate that since the beginning of the year, we got 90,000 returning citizens from mostly Hong Kong and to an extent the US. There are 400,000 Canadians, no, 3.5 million Canadians living outside Canada. 400,000 of them are in Hong Kong, and we know what's happening in Hong Kong. That's something that people are not talking about, but it's happening. And then you have immigration. The quota will come back. The minute we have a vaccine, rapid testing, they will come back. And yes, we will have to compete with the Americans, and that's why we have to make sure that we promote ourselves in the right way. But this is a major force. We need new immigrants desperately to see economic growth. And that will continue to benefit the housing market. It will go to the rental market, the rent for the first 3 years, and then the buy. So I think that will be supportive for Canadian real estate, regardless where you live and what unit you are, what kind of unit you're selling.
So again, you made a comment about downtown Toronto with respect to outside Toronto. I could tell you anecdotally, we have this in our own experience in our business, but I've heard this from many, many people. Like rents in areas outside the downtown core actually didn't get affected either by rent or by occupancy in any very big noticeably way. The downtown Toronto did get affected, and the government posts rates, but that's a lot to do with the fact that there's nobody working downtown. The offices are empty and universities are empty, and the expectation is that would come back pretty quickly.
I agree. I think that the aspect of university students, non-permanent residents, which is 150,000 a year in Canada, huge, a major factor impacting the rental market, not there. Again, if I'm right, and we are going to see a rapid recovery in the second half of 2021 into 2022, I believe that all this will come back. And by 2023, this will be distant memory, I believe. And I think that the fear of living in a condo and taking an elevator will disappear. We have to be careful not to exaggerate the long-term impact of this crisis.
All right, we had a specific question about the office market. The downtown, especially the high buildings where, you got to wait in the elevator and everybody's nervous, how many people can put into the elevators. But how do you see the office market behaving going forward a year from now?
I think that short term, clearly, it's not going to be good, and the vacancy rates will continue to rise. Subletting will be an issue, cap rate will be an issue, valuations will adjust accordingly, and it's happening. We all know that. So the office in the next 6 months will not be great, even beyond that. However, if you look at the office market 2 or 3 years from now, and you look at demand for office space, high quality office space, it will be lower than it was before the crisis, and that will be a permanent thing. But it will be lower, let's say, by 10%, not 50%. And the market will adjust, cap rates will adjust, and that will be the end of it. So I don't see the end of the office model by any stretch of the imagination. However, I see much more flexibility. For example, we experience Zoom already. We experience working from home. We know what it is. So I must admit that if tomorrow it is -20 and it is snowing, I'll be working from home that day. Yeah? The concept of rush hour is becoming primitive. Why everybody has to go to the office at 9 o'clock and leave at 5? That will change, I think, on a permanent basis, but it will not reduce demand for office space because every individual will need to have more space in the office. So that will compensate to an extent. Overall, I do suggest that vacancy rates will rise, demand for the office market will go down, 10%, whatever the number is. Not a game changer, but the market will adjust.
Well, even speaking about yourself, I understand CIBC prided themselves on having open offices, right? Is Victor going to give you your own office now?
I have my own office now, but you know, we are moving to a different location, so I don't know what will happen exactly. We'll see. Really don't know.
Okay, we're going to have one last question. It's actually a cute question somebody asked. Imagine, hypothetically, we expect it to be hypothetically, this morning, the Supreme Court of the United States said, yep, we're not going to count 300,000 votes. And what do you know? Trump's going to be president for another 4 years. Would your speech have been any different?
Oh, yes, it will be very different. It will be very different on many aspects.
So we reschedule
we'll reschedule a call, yes. But I don't think it's going to happen.
Yeah.
Yeah.
Well, Benjamin, I could tell you on behalf of all of us in Lanterra and all of your audience, your words were very much illuminating. Personally, as somebody who runs a fairly large real estate company downtown Toronto, I'm very much encouraged about the future. I do think, as I think all of us do, that we're in for several difficult months, especially with the winter. We had a great summer, but there is a light at the end of the tunnel. So again, on behalf of everybody here, again, thank you, stay safe, regards to your family, and hopefully we'll hear you again sometime in 2021. And we'll have a look back and see if it was really so.
Yep.
All right, be well. Thank you so much.
Thank you.
Signing
Good
off.
luck. Good luck. Bye-bye.